All right, let's talk about something we use literally every single day: money and credit. We're going to dig into how we went from, just trading stuff to the wild financial world we live in now.
I mean, have you ever really stopped to think about it? Why can this little piece of paper or just some numbers on a screen get you a sandwich for lunch? To figure that out, we've got to rewind way back to a time before money even existed, a time of barter.
So, Section 1, a world without money. We're diving into the problem of barter. Now, before we had cash, there was just trading, direct exchange. Sounds easy enough, doesn't it? Well, as you're about to see, it was a total mess.
Okay, so picture this. What if you had to trade, say, a pair of shoes you made for a bag of wheat? Imagine you're that craftsman. You spent all week making something really high quality, and now you're hungry. What do? Well, you've got to find someone who not only has the food you want, but also happens to want the exact thing you just made.
So let's put this into a story. Here's our shoemaker. He's got a fantastic selection of really sturdy shoes. His family needs to eat, so he heads to the market, hoping to trade his shoes for some wheat. And he finds a farmer who has tons of wheat. Perfect, right? But hold on. The farmer takes one look at the shoes and just shakes his head. Sorry, he says, I don't need shoes. I need clothes. And just like that, the deal is off. Our shoemaker is stuck, and he's still hungry.
And this exact problem, this is the fundamental flaw of the whole barter system. Economists have a fancy name for it: the double coincidence of wants. Yeah, it's a mouthful, I know. But all it really means is that you and the other person have to get incredibly lucky and want exactly what the other one has. You just can't run a whole economy on luck. Humanity needed a better tool, and fast. Which brings us to our next section: how money and banks work. Humanity's first two big solutions. To solve this whole barter nightmare, we came up with a revolutionary invention: money. Something everyone just agrees has value. Something that can act as a go-between in any trade. And you can see the incredible evolution of what we even call money right here. I mean, it started with stuff that had its own built-in value, right? Like grains you could eat or cattle you could farm. Then, for thousands of years, it was tied to precious metals: gold, silver. But look where we are today. That paper in your wallet, it has no value on its own. You can't eat it. It's valuable simply because we all agree it is. It's a shared belief, a trust in the system that's backed by the government. That is a huge mental leap for humanity when you think about it. Okay, so you've got money, the barter problem is solved. Great. But now you have new problems, don't you? Where do you keep it safe? And how can you make that money work for you? I mean, money just sitting under your mattress isn't really doing anything. And this leads us to our second great financial invention: the bank.
The best way to think about a bank is like a matchmaker for money. Seriously, they act as this bridge, connecting people who have extra money, we call them depositors, with people who need money, the borrowers. It's a really simple but incredibly powerful idea that keeps money moving through the entire economy. So, how does this actually work? Let's break it down. Step 1, you deposit your extra money in the bank. Simple enough. Now, the bank knows that not everyone is going to come asking for all their cash back on the same day. So they just keep a small piece of it, let's say 5%, for daily withdrawals. Then, and this is the magic part, they loan out the other 95% to someone else who needs it. This whole process, this lending of deposits, is literally how banks create credit. And that brings us right to the heart of this whole discussion: credit. Is it an opportunity or is it a trap? Because loans or credit are one of the most powerful tools in modern economics. It can build fortunes, but it can also absolutely destroy livelihoods. It's a real double-edged sword. To really get a handle on this, let's look at two totally different stories. On one side, we have Salim. He's a shoe manufacturer who sees a big opportunity on the horizon. And on the other side, we have Swapna, a small farmer who's just trying to make it through the planting season. Both of them turn to credit, but their stories, well, they couldn't be more different. So, Salim gets this huge order for an upcoming festival. He uses credit to buy the leather he needs and to hire some extra workers. He works hard, delivers all the shoes on time, and makes a fantastic profit. He easily repays his loan, and his business is now bigger and better than ever before. For Salim, credit was like a ladder to success. But what about Swapna? Her story is very different. She takes out a loan to buy seeds and fertilizer for her crops. But then, disaster strikes. Her crop is hit by pests and it fails completely. Now, she can't repay the loan. The debt starts to grow. The next year, she has to take another loan just to plant again, and now she's caught. Instead of helping her, credit has pushed her into what's called a debt trap, forcing her to sell off part of her land just to pay it back. She's left much, much worse off.
Okay, so why? Why did credit work out so well for Salim, but was a complete disaster for Swapna? A huge part of the answer comes down to where they got their loans. And this introduces us to the two very different worlds of credit, the formal versus the informal.
Now this chart, it really reveals a surprising truth about where people in rural areas get their credit. You've got the formal sector, the regulated banks and cooperatives, and that makes up a little more than half of all lending. But look at the other side. A massive chunk comes from informal sources. Nearly a quarter of all credit comes from local moneylenders who are operating completely outside of these regulations.
And this next chart, wow, it makes the inequality just crystal clear. We're looking at urban households here. For poorer families, they're forced to rely on these informal, often super expensive loans for more than half their needs. But look at the wealthier households. They get a whopping 83% of their credit from the cheaper, safer formal banking sector. The difference is just staggering.
So here's the crucial point, the main takeaway from all this data. The wealthy get access to cheap, safe credit. The poor, who often need it the most, are left relying on expensive, risky loans. This isn't just unfair, it's a system that can easily push people further into poverty, just like we saw with Swapna.
So, how do we close this credit gap? This is a massive, massive challenge. But it's also where some of the most powerful and creative financial ideas are coming from. The big question is, how do you get safe, affordable credit to the people who need it most? Well, there's a path to empowerment.
And this incredible idea was really championed by the Nobel Prize winner, Professor Muhammad Yunus. Just listen to this. If credit can be made available to the poor people on terms and conditions that are appropriate and reasonable, these millions of small people can add up to create the biggest development wonder. He saw that the poor aren't a risk, they're an opportunity.
And this is one of the most successful solutions in action. It's called a self-help group, or an SHG. What you're looking at is a group of women in Gujarat meeting to manage their finances together.
The model is so simple, but it's absolutely brilliant. Here's how it works. A small group, usually about 15 to 20 women, all pool their savings together. Then, that small pool of money is used to give out small loans to members of the group who need it. But here is the real game changer. The group guarantees the loan. And just like that, they've solved the single biggest problem the poor face when trying to get a bank loan, not having any collateral. Now, a bank isn't lending to one person with no assets, it's lending to a trustworthy, organized group. This unlocks the door to formal credit and truly empowers these women to build their own futures.
So, when you step back and look at it, the story of money, from the ancient problem of barter all the way to modern solutions like self-help groups, it's really a story about human problem solving. It shows us that finance isn't just about numbers on a spreadsheet. It's a powerful tool that can either trap people or empower them. And that leaves all of us with a really important question to think about. How can we keep innovating to make sure this tool builds a better, more fair world for everyone? Thanks for joining me for this one.